It does seem like we're starting to already trade this idea of higher yields and how that's going to pressure equity markets. Do you think that is the dynamic right now that is pressuring equity markets? And if so, how far does it have to run?
Well, yes, absolutely. It's clearly something that took a bit the markets by surprise, and it's linked to the Fed dots, where the timing of the interest rates hiking cycle was essentially pushed forward, a bit faster than expected. So the equity bond correlation is clearly something to watch, because higher bond yield is increasing the discount rate for equities. But it is also important to realize that we are bouncing back from the COVID crisis with $12 trillion of fiscal and monetary stimulus that has boosted the economy. So companies are still reporting very strong earnings. The earnings momentum is quite significant. If you look at commodity, material, all the green-related equities in terms of energy transition, et cetera, because you'll see a huge amount of capex, and also the Green Deal in the US and in Europe is going to drive earnings and top-line growth there. So we're still in an environment of significant excess savings. The cumulative excess saving in the US is $2.5 trillion, which is 11% of GDP. So that should drive demand going forward. So we're not too worried about the bond yield. We have a target of 1.7 for the end of the year of the 10-year US. So we think it is consistent with the reflation trade.
Kokou, you mentioned that bond equity correlation. I know we've spoken in the past where you've said if they start to sell off together, that's when we worry about this systematic selling of volatility funds, risk parity, those types of investors. As we see stocks wobble and yields move higher, are you concerned that we will see that trigger of systematic selling?
Well, yes, that's clearly a risk, but I don't think we're there yet. But the big difference this time around is the fiscal stimulus that's quite significant. And this is one of the things that has driven the recovery in stocks, because you've seen a lot of balance sheet repair have been done by companies. They are rich in terms of cash and a strong cash flow as well. And there's also a lot of growth in terms of capex that's being deployed. So I think the equity and bond market are telling the same story, which is an environment of strong growth. Clearly, China in the backdrop is an issue, and then you see the market a bit wobbling. But you have to remember, the first quarter of this year, we had equity going up and bonds selling off, and that was the reflation story. We then took a bit of a pause because we were worried about a third, fourth wave around the Delta variant. But I think we are resuming that trend of higher growth being expressed through sort of more resilient equities and bond market that's selling off a bit.